Good morning and welcome to Charting the Markets on Friday, the 22nd of September. There is not much data out today on the economic calendar, but at 2:45 p.m. we've got US flash PMI data out of the United States for September, and we expect manufacturing to rise to 48.8 and services to fall to 49 versus a previous reading in last month of 50.5, and that signals a contraction. And similarly, this morning, PMI data out of the Eurozone was quite mixed. We had better than expected services PMI, but weaker manufacturing PMI out of the Eurozone for the month of September. And in the United Kingdom, it was the opposite. We had better than expected manufacturing PMI and weaker services PMI. We also had retail sales out, which came in at 0.4%, slightly worse than an expected rise of 0.5%, but much better than the reading we saw in the previous months, where we had a minus 1.1% retail sales data out, and that was due to basically bad weather and also a lot of strike action by the likes of NHS doctors and railway union workers, etc. Now, with regards to the equity markets overnight, yesterday we had another sharp sell-off, I should say, in US markets, and that was due to the hawkish pause which the Fed has had since Wednesday of this week, where it basically said that it was going to keep its rates higher for longer. And that has led to equity markets coming off on the back of risk-off sentiment. And in Asia earlier this morning, we also had a mixed session due to the follow-through of this weaker US session, and also because of the Bank of Japan basically holding its rates at its minus 0.1%. So basically holding rates steady there. And the 10-year yield, the bond yield, still trading around the 0% mark. And basically what we can see is that in Japan, at least, annual inflation is also edging down to 3.2% in August. And that's the lowest reading it had in 3 months. And I'll show you some charts with regards to currencies later on. But let's begin with indices, and let's have a look at the UK FTSE 100. As we can see here on the daily financial bet, on the back of yesterday's US market selling off, the FTSE also sold off very strongly, having tried to reach but nearly did so. It actually failed just below last week's high at 7,747, and then we fell back down again to the red line here, the 200-day simply moving average at 7,646, which now for the 5th consecutive day has held. And this is why I love technical analysis. And basically, we are bouncing off this 200-day simply moving average and heading back up again towards last week's high. And that was a high which was basically last traded at the end of May. And if we were to manage, but it's a big if, because a lot of other equity indices are at key support, and I'll show you in a minute why I see that. But as we hold there, potentially, we could see the FTSE actually outperform and rise above last week's high. If we do so, then a major bottom here would be formed, and we could actually head back up again towards the 7,938 high seen in April of this year, and also the psychological 8,000 mark. But as I say, it's a big if. Short term, we're holding above these lows, and basically short term, provided we stay above yesterday's low at 7,633 on this daily financial bet, further upside may actually be seen at the beginning of next week. And then we'll have to see whether we can keep on holding above the 200-day simply moving average and this week's lows. As long as we do, this uptrend is still intact. But it is quite fragile. And the reason for this is, if I go on to the European markets and the DAX 40, for example, you can see here that on the DAX 40 index, the German stock index, we actually yesterday not only fell through the 200-day simply moving average here in red, but also through the previous lows going back to July of this year, and dipped down to a slightly lower low this morning at 15,451. And we have to see whether we can manage to hold above there at the end of this week, which is Friday, and then whether we can hold and bounce off this major support area here for this year next week. If we can, then once again we could see a reversal to the upside. But if you look at seasonality, the last 2 weeks of September are quite often negative, historically speaking. If you go back to all the time back to the Second World War, basically the late 1940s, and also October is quite often a month where we see a rise in volatility. So it wouldn't surprise me if, even if we were to see a short-term bounce today, next week we were to fall through this major support area. And if that were to happen, where could we get to next? Well, basically, we have the highs seen in mid-January of this year at 15,272, which could present a potential downside target for the DAX, and then the psychological 15,000 mark. But even if this were to happen, yes, we would form a toppish formation here, but provided we stay above the March low at 14,459, I know it's a long way away, but provided we stay above there, the long-term uptrend we've been in since October of last year would remain intact. But watch this space. Next week, volatility could increase even further, and we could see some nasty surprises to the downside if we were to fall through these key support areas, not just in the European sessions, but also in the US. I mean, the same story is here happening on the S&P 500, as you can see here on this daily financial bed. So we are starting to keel over very clearly. We've had a week of consecutive daily losses on the S&P 500 take us to a 3-month low, and to yesterday marginally below the June low, to levels last traded in mid-June of this year, to 4,324, above which we're trying to hold at the moment. But as you can see here, the momentum is clearly to the downside. So even if we were to today see some short covering, and for us to perhaps close above this low, the odds are actually stacked in the bear's favor short term. So if we were to fall through these lows, and basically what I'm talking about are the lows from June, late June of this year, August, and also now this week's low between 4,337 and 4,324, then the next downside target would be the mid-May high 4,214, also the early May high at 4,187, and then the psychological 4,200 mark, where the 200-day simply moving average here in red is also coming in. So this is the downside target zone for the S&P 500. If we were to reach that, it could still be, from an elliott wave perspective, a big zigzag correction, so an ABC correction to the downside, which we could then follow through with another upside, taking us back towards these highs, perhaps in the first quarter of next year. But right now, we are at key support, and we need to see whether we can hold at that key support or not in the next week. The US dollar is on track for its 10th consecutive week of rising prices, and that is quite unprecedented. Last time we saw 9 consecutive weeks was back in 2014. And if we look at the US dollar basket, we can see here that we continue to rise, and the latest upsurge here has been seen because of the hawkish pause the Fed basically commented on Wednesday at the Federal Open Market Committee meeting, where, yes, it kept its rates on hold, but it left the door open for another rate hike to be seen before the end of this year. And it also basically said that the odds were pretty high that the Fed would keep its rates high until the late summer of next year. And that has led to risk-off sentiment to equities coming off, but also to the US dollar once again surging higher and continuing its ascent from its July low. And so far on the US dollar index, we're trading at 105.44. And if that were to be taken out, which looks pretty likely, then the next upside target is the 105.51 March high. And this is also key because that could act as resistance. But if it doesn't, well, the next upside target would then be the high seen back from November of 2022 at 106.87. But as you can see here very clearly, we are now in an uptrend with regards to the US dollar. It is likely to continue to appreciate, and short term we remain bullish on the US dollar basket, provided we stay above Wednesday's low at 104.33 and remain within this uptrend. Now, what does that mean for other currency pairs, such as US dollar against the Japanese yen, for example? Here we saw earlier this morning the Bank of Japan stick to its dovish stance and basically keeping its interest rates at minus 0.1%, and also the yield of its 10-year bonds at around 0%. And as you can see here, we are basically heading back up again towards this week's high at 140.80 yen and 46 sen. And once that is taken out, which looks pretty likely, we could be heading towards the psychological 150 area, where the Bank of Japan may, though, intervene. But yes, the trend's your friend, and here on dollar yen, we can see we have a series of higher highs, higher lows, which is the definition of an uptrend, and further upside is very much in store with regards to this currency pair here, provided we stay not just above, because this is quite tight here and quite close above yesterday's high, 147.32, but more importantly above the major last reaction low, that is to say the low from the 11th of September at 145.91. Provided we stay above there, further upside is more likely to be in store than any downside reversal. Now, another currency pair I would like to look at is the British pound against the Japanese yen. And as we can see here, we've been coming off the August high, and yesterday dipped down to 180 yen and 81 sen. And that was not just because of the Bank of Japan keeping its dovish stance, but also as annual inflation in Japan basically edged down to 3.2% in August, its lowest in 3 months. And so far we are holding above that low here. But as you can see here, the British pound has actually been depreciating against the Japanese yen, as the Bank of England this week kept its interest rates at 5.25% and didn't hike its rate, and also said that it may not need to hike rates further, but it did leave the door open for another rate hike if inflationary pressures were to continue to rise. Now, obviously, the rise in the oil price could lead to these inflationary pressures, but this week out of the US, we actually did see inflation come down a bit despite this rise in the oil price. I mean, over the last 3 weeks, the oil price has risen by about 15%, and since the end of June by over 30%. So coming down the line in October, for example, perhaps we could see inflation pick up again. And obviously, that would also reaffirm the stance by the Fed and other central banks that they will keep their rates higher for longer, but not the Bank of Japan, which remains very dovish. But despite that, the British pound has actually slid against the Japanese yen. If we were to fall through 180.81, yesterday's low, the next downside target would be the early August low at 180.45, and then basically we would have the psychological 180 area, and then below there we also have the mid-July low 179.48 as a potential downside target. But as you can see here, right now we are drifting lower, and provided we stay below the orange line, the 55-day simply moving average at 183.03, further downside seems to be in store for the British pound against the Japanese yen. Now, another currency pair which is quite interesting is the British pound itself against the US dollar. And as we can see here, as the Bank of England kept its rates unchanged at 5.25%, this currency pair continued to slide versus the US dollar. Yesterday we hit a low which was a 6-month low at 122.35, and it looks as if we are heading down towards the mid or the late February high at 121.43 as our next downside target, and perhaps we could even slide further towards the psychological 120 area. As you can see, we remain in this very tight downward trend channel, which we've been in since late August of this year, but clearly we are still also in a very much a medium-term downtrend from our July highs we saw, and have fallen so far by about I believe it is 7%. Let me just have a look at this. Yes, it's about 7% that we've fallen from those highs. And there is no technical sign saying that we could bounce back at any time soon. I mean, the trend's very much intact here and very much pointing lower. For this bearish view to be questioned, we would have to rise above the red line here, the 200-day simple moving average at 124.35. But that looks to be pretty unlikely in the short term. The rising US dollar for probably, the 10th consecutive week this week, and the impact that it has had on commodities has been basically quite negative. As the US dollar rises, it becomes more expensive for investors and people or companies who buy the currencies or commodities to buy those commodities, which are normally denominated in US dollars, and therefore the impact is quite often negative when as the dollar rises, the commodity prices come off. But there have been a lot of exceptions, and one of these is basically the price of crude oil. As we can see here on WTI, we have seen a small retracement in a very strong uptrend. With this rise we've seen over the last 3 weeks of around 15% in the oil price, taking it or WTI to at least to 92.38, so $92.38. And that was interesting because from a technical perspective, it meant that we failed just below the October and November highs of last year between $92.70 and 95 cents. And now we are once again heading back up towards that key resistance area. If it were to be breached, we could then potentially rise all the way up to the psychological $100 mark for the oil price. But right now we are basically resuming our uptrend, and that will remain the case as long as we stay above yesterday's low at $88.28. If we were to fall through there, we could see a sideways to slightly bearish consolidation phase take shape, but it is not likely to take out much of this previous very strong uptrend. Moving on to the price of gold, as I said, as the US dollar is on track to reach its 10th consecutive week of gains, the price of gold is actually sliding, but it is trying every so often to then bounce back on risk-off sentiment, for example, in equity markets. And this week we saw that basically take the gold price to $1,947 per troy ounce. But then once again, we're coming off again. We're now trading below the red line, the 200-day simply moving average at $1,926. So what are the key levels to watch out for if you're a trader? Well, basically, the area we've seen from the beginning of this month between $1,947 and $53 per troy ounce is key resistance, and good support comes in between the low we saw last week and also the June low between $1,901 and $1,893 per troy ounce. So further range trading is in store for us probably for the next few days between these boundaries. But if we were to break out and if we were to fall, for example, through the August low at $1,885, then we could see a resumption of this downtrend we've been in since the high seen back in May at $2,082. And on the flip side, if we were to manage to rise above $1,953, we could be heading back up again towards the psychological $2,000 mark. But right now, we're just trading in a sideways trading range. And last but not least, I'd like to talk about the silver price. And silver is really interesting because every time we go down towards the $22 mark, we bounce off this and basically have a bullish run afterwards. So we saw that back in June and July of this year. We saw that in August, and we're starting to see that now in September. So here we've managed to rise above the 200-day simply moving average here in red at $23.48, I should say. As you can see here, we're now testing the 55-day simply moving average here in orange at $23.70, and seem to be heading back up again towards the mid-April to late April lows between $24.50 and also the highs seen back in early June of this year, $24.52. So that's the next upside target for the price of silver, provided we stay above this week's low made on Thursday at $22.82. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X, formerly known as Twitter. My handle is @AxelR_IG. Have a lovely weekend.